location, and if you live in the West Coast, well, it might be impossible because people routinely spend more than 10 times their annual income on housing. But as a rough rule of thumb, this can work and does work if you want to play it safe. To me, this 30-33 rule is probably one of the safest, most conservative routes you could take when it comes to home ownership because it ensures that you don't take on too much before you're able to afford it. However, in terms of what a lender looks for and how much you could actually get, it's quite different. So here's what you need to know. In terms of how much you could afford, lenders usually only care about two things, and that would be income and debt. The income part is pretty straightforward. It's simply how much money do you make every month, do you have stable employment, and do you have 1 to 2 years of tax returns? If the answer is yes, well, this part's pretty well handled. However, the next part of debt is a little bit more complicated. See, anytime you qualify for a mortgage, lenders will look at what's called your debt-to-income ratio, which calculates how much money is left over after your expenses. In this case, most banks want a debt-to-income ratio below 45%, which means less than 45% of your take-home pay goes towards paying off your debt, including your mortgage. So as a quick example, if you're making $8,000 a month, a lender would look at that and give you up to $3,600 a month to be used towards all of your debts. In this case, if you have a $500 student loan payment, a $700 car payment, and a $100 credit card payment, that leaves you with $2,300 a month left over to spend on housing, which buys you something in the $350,000 range, assuming